everybody, and thank you for watching one of our AT&T focused webinars here at the Retirement Group. I'm Sam, and I moderate these webinars for you. In just a minute, we are going to be joined by Tyson Mavar, who is one of our senior advisors here, and he is going to be giving a quick update of the AT&T interest rates and telling you a little bit more about that. But before Tyson comes on, I'd like to quickly remind you that we are not affiliated nor endorsed by AT&T. The Retirement Group is a completely independent group of financial advisors, so please keep that in mind as you're listening along with Tyson today. Please pop open your chat window. We will have some links being entered in there throughout Tyson's presentation that will guide you to several different resources that we have to offer, one of which will be a link to our AT&T focused retirement guide. Another will lead you to the appointment calendar where you can book an appointment with Tyson himself or one of his colleagues if you wish after his presentation to speak to them directly about your specific concerns or situation. And after Tyson's presentation, I will rejoin him very quickly to ask him some of the questions that may have come through the Q&A box. Please feel free to stick around for those. If you have a question, feel free to ask away in the Q&A box. It's completely anonymous, and Tyson will answer as many as he can, time permitted. And with all of that boring stuff out of the way, now I'm going to turn off my camera so Tyson can get started. Hey, Tyson.
Hi, Sam. Thanks everybody for joining our webinar series today. My name is Tyson Mavar. I'm one of the AT&T focused retirement advisors for the Retirement Group. And on today's webinar series, we're going to talk about what's been happening this year with interest rates as it pertains to the AT&T pension lump sum. As many of you know, AT&T offers a lump sum to not all, but most employees, managers and non-management employees. And current interest rates impact lump sum payouts. So we watch these very closely as we have many clients from AT&T. And if you're not a client of ours, we hope you might consider becoming a client one day. And this is something that we spend a lot of time with our clients as they approach not only their retirement date, but also the date that they commence their pension benefit. Let's get right into it. First thing it's important to know about as you're approaching retirement, if there's any possibility you might be considering taking a lump sum on your pension, it's important to know the timing rules and something called a look-back period. AT&T locks in the lump sum interest rates for an entire year, and they only change them once per year on January 1st. Now, the look-back period is based off of November interest rates of the prior year. And what this look-back period is, it essentially gives you as an employee a bit of advance notice on what's happening to the interest rates and what's likely going to happen to your lump sum as a result once the company changes these interest rates on January 1st. Now, the IRS updates the interest rates monthly that are used to calculate many pension plan lump sums around the country. And by plan rules, AT&T uses only the November interest rates to calculate the following year's lump sums. So while only the November rates are relevant to the pension calculation, we track the monthly interest rates throughout the year so as to gauge where these interest rates are going and as a result, what is likely going to be the direction lump sums will be going at the end of the year. And this helps us to advise folks on not only the best timing of retirement, but the best timing to commence your pension. And in many cases, the two don't have to coincide. Oftentimes, we will recommend our clients wait to take their pension in an effort to get more money in their lump sum, but that's not always advisable. So it's important to work with somebody that understands this pension plan, we believe, in an effort to not leave any money on the table when you leave AT&T, to walk away with the most benefits possible at retirement. I'm going to zoom in on this table here. What we're looking at is the November interest rates for the last few years. At the very top, this is the current interest rates. If you retired from AT&T today and took your pension before the end of the year, you would be getting these three interest rates. You could see there's first segment, second segment, and third segment. These are correlated to corporate bond interest rates, short, intermediate, and corporate bond interest rates. And it's the second segment rate that carries the most weight in the lump sum calculation. For example, it's 3 times more relevant in the calculation than the first segment rate, and close to 3 times as relevant as the third segment rate, depending on your age or life expectancy. Now, you'll notice that all 3 of these rates went up compared to last November, November of 2022, which was what interest rates were used to calculate anybody's lump sum who took their pension last year. and unfortunately it resulted in slight decreases to lump sums for 2024. Not nearly as big of decreases as we saw from 2022 to 23, fortunately. But you can see these rates can tend to change pretty dramatically on a year-by-year basis. That 2022 to 2023 jump was the biggest I've ever seen in my 13 years with this company and working with AT&T retirees. And we don't see that very often, but it is possible. But it's also possible that rates go down, which means your lump sum will be going up. In fact, although it's not shown on this table, the interest rates for January were recently published. And we've actually seen 2 months in a row of declining interest rates. And if this continues through the year, we anticipate seeing some pretty big increases to lump sums come January 1st of 2025. Now, it's uncertain and very unpredictable where these interest rates will go. The Federal Reserve has suggested in the past they could see some interest rate cuts this year. That is dependent on both inflation as well as economic numbers related to corporate earnings as well as unemployment. But we'll see what happens. But the IRS updates these monthly, so check in with us either by watching these webinars or by scheduling a call with myself or one of my colleagues periodically throughout the year so we can give you an update on what's happening and you can make good decisions on your retirement date as well as how to take your pension. And while the lump sum is still very popular, even in this higher interest rate environment, it's not right for everyone. So we think it's critical when you run your retirement analysis, which is something we'll do for you complimentary if you like, to compare different pension options. And the annuity could make more sense for you and your family depending on a variety of different factors that we'll go through with you. Now, here's another graph of what's happened to interest rates going back to 2013 on all three of the segments. And you can see typically the third segment is higher than the second segment is higher than the first. There's instances, especially recently, where these rates have converged and they're not much different than one another. In fact, we actually saw an inverted yield curve recently, which means that longer term bond interest rates are lower than short-term bond interest rates. In the past, that has in some cases been indicative of a recession, not always, but something that we are watching very closely because not just as it comes to the interest rates when we're looking at retirements, but also when we're building portfolios, looking at stocks and bonds and the types of stocks and bonds we recommend to our clients. We pay very close attention to this stuff, but moral of the story, rates are as high as they've been since I've been at this company. 2013, the third segment rate was in line with where all three rates are today. But as a result, we've seen some reductions in lump sum payouts, but that's not permanent. Of course, we can't predict where interest rates are going. It seems very possible rates could continue to drop this year, resulting in some pretty big increases to lump sums come next year. Now, here's an example of when you go onto the net benefits website on Fidelity and run multiple benefit projections, which we strongly encourage you to do, and we're happy to walk you through this process. You have the option of changing your retirement date, you can change your benefit commencement date, and you can also assume different interest rates in an effort to see what happens to your lump sum given an increase or decrease to interest rates in the future. If you don't change the interest rates, it's just going to keep zeros in here, but it's going to use the existing interest rates that we just saw in the last couple slides. And this is how we strongly encourage everybody plan for their exit from AT&T, assuming that you get to choose your exit date. That's not always the case, especially with the push the company has been giving employees incentives to move to other parts of the country, or not necessarily incentives, but disincentives to not move, I guess I should say. We don't always get to choose our retirement date, unfortunately, but in the case that we do, we want to make sure we pick the best possible date to walk away with the most possible money. And here's how you do it through the net benefits modeler. And we also have an example of the output, some of the outcomes when you run different pension projections. You can see a lump sum This person might not have reached their Mod 75 criteria, which doesn't affect everybody, but affects a lot of employees. So talk to us if you're not sure how to figure out when you hit that Mod 75 milestone. If you don't, and you're supposed to, based on which pension plan you're on, it could mean hundreds of thousands of dollars lost on your pension. So pretty important to understand that better and hit it if you're able to. And then the other benefit options like the single life annuity, joint 50% survivor annuity. There's also a joint 75 and 100% survivor annuity on many of the pensions. Some people have a partial lump sum with residual annuity. All these things need to be considered. And in light of your circumstances, whether or not you're married, whether or not you plan to go back to work, your tax bracket status, your health and life expectancy, whether or not you have children, your risk tolerance. There's a lot of factors in deciding on the optimal pension option with the highest degree of certainty. These are things that you should talk to your financial advisor about, and we would like to talk to you about when we run this retirement analysis. So let us know if you'd like to spend some time with us going through this website, because there's a lot of great information on here. You can see this individual, that first projection, they were not hitting their service pension eligibility, as it's called. And they were receiving about half of the pension compared to when they projected they would hit their Mod 75 criteria. So pretty important stuff. This can make or break a retirement, getting the timing right on this, not only retirement, but benefit election. And while retirement is probably one of the most important things to plan for, more important than vacations, more important than birthdays, unfortunately, most people don't do it. We found out because it's not the most exciting thing. A lot of people are nervous about it, so they just don't think about it. It's just a uncomfortable thought for many people. And statistics say that 74% of Americans over the age of 50 don't even have a plan for their retirement. We'll do this for you for free, folks, if you're willing to spend some time with us. The reason we do it for free is because we're confident that at the very least, you will get enough value from this that you'll help us grow our business by referring some of your coworkers to us. And who knows, you may even become a client if you decide to work with an advisory firm, which we're delighted to talk to you about how that works, what the cost is, and what services, in addition to the retirement planning, come with that. So with that, we're going to wrap it up for today's webinar series. But if we did have some questions, Sam, we do have some time to go through a few.
All right, Tyson, thank you. Yes, first question. With the way interest rates are now trending, when would be the best time in 2024 for me to retire from AT&T in order to get the highest lump sum?
You know, it's tough to say because we don't know where interest rates will be in November, unfortunately. If you are planning to work until the end of the year anyway, that gives us a better indication, even if it's in September, October, we'll say. Then we have more certainty on what the rates will be in November, but it's just too early still to say which direction rates are going to be going. That could be a reason to extend either your employment with the company a little bit longer for the possibility that rates go down, or some of you can actually defer the election of your pension. So if, let's say, AT&T chose your retirement date for you, either through a surplus or a forced move, you could wait to take your lump sum with the hope that interest rates go down and commence your benefit on January 1st. Now, not everybody can do that. This is really important. If you are over 65 already, 65 is the normal retirement age, so they will force you to commence your benefit on the next available commencement date after your retirement date. This is for people that are over 65. There's also some non-management plans that force a benefit commencement for the lump sum within 90 days of your retirement. So with AT&T having close to 20 pension plans, it's important to understand the specific rules on your plan, and we can talk to you about those if you call us. But the question was, what's the best time to retire? It's tough to say still, but it's seeming fairly likely that rates could go down, and there could be an incentive either to work until the end of the year and commence your benefit January 1, or just wait to commence your benefit, even if you retire before the end of the year, if you qualify. So talk to us about that if you're not sure.
All righty, Tyson, thank you. We're going to do one more in an effort to keep this short. With interest rates fluctuating so much, is it better to take the annuity?
I don't think The fluctuation of interest rates is a reason to take the annuity. Now, with higher interest rates, that could be a reason to take the annuity. Although the flip side of that is higher interest rates allow you to earn a higher rate of interest on your lump sum in the safe environment and things like CDs, money markets, annuities, and fixed income investments like bonds. There's a lot of reasons that you might consider the annuity, but I don't think the volatility of interest rates is one of them. In fact, the volatility of interest rates on the downside, driving interest rates down, is potentially more of a reason to take the lump sum if it results in a higher lump sum for you, and that could absolutely be the case. But there's a variety of reasons, a variety of things you want to consider before deciding which way to take your pension. Let us know if you'd like to run the cash flow analysis, because I believe that is the best way to evaluate all the various pension options that you have.
And as a reminder, the link to that cash flow analysis is in the chat. Alrighty, Tyson, that was all we have today. Any last thought or anything before we go?
I think that's all I have today, Sam. Thanks for the help today, and thank you all for attending our webinar series. We hope to talk to you soon.
Thank you, everybody, and thank you, Tyson. Have a great day.